Let me tell you something about credit that most people don't understand. An 800 credit score doesn't automatically mean banks are going to throw money at you. You can have an 800 and still get denied. You can have a 720 and get approved for a card someone with an 800 didn't get.
What?
Why? Because lenders aren't just looking at the number you see on your credit app. They're looking at the entire credit profile, your payment history, how much debt you're carrying, how much available credit you have, how long you've had credit, how recently you've applied for credit, your income, your existing relationship with the lender, and the specific underwriting rules of the bank you're applying to. So if you're young, new to credit, sitting at a 500, 600, or 700, don't obsess over hitting 800. Build a profile that makes lenders comfortable saying yes. And I'm going to break down exactly how to do that from the beginning. Part 1, understand the game. First, understand what a credit score actually is. Your credit score isn't a bank account. It isn't money. It isn't your net worth. It's basically a statistical measurement of how you've handled credit. FICO breaks its scoring system into 5 major categories. Payment history, 35%. Amounts owed, 30%. Length of credit history, 15%. New credit, 10%. Credit mix, 10%. Those percentages aren't a perfect formula that lets you calculate your exact score, because FICO says the importance of individual factors can vary depending on the person's profile. But it tells you something extremely important. Your credit score is mostly about risk management. You're trying to prove, give me money and I will pay you back. That's the game. Part 2. Find out what you actually have on your credit. Before applying for anything, stop guessing. Pull your credit reports. Look at all 3 major bureaus. Don't just look at the score, look at the actual accounts. Look at who is reporting you, your payment history, balances, credit limits, account opening dates, collections, hard inquiries, closed accounts, authorized user accounts, anything you don't recognize. And here's one of the biggest overlooked opportunities: errors. If a creditor is reporting information incorrectly, you have the right to dispute inaccurate or incomplete information. That doesn't mean you can dispute legitimate debt because you don't feel like paying it. That's not a hack. That's nonsense. But if something is genuinely wrong, challenge it. The CFPB specifically recommends disputing inaccurate information with both the credit reporting company and the company that furnished the information, Consumer Financial Protection Bureau. And you don't need to pay a credit repair company just to submit a legitimate dispute. You can do that yourself for free. Consumer Financial Protection Bureau. That's an actual credit hack. Knowing your rights instead of paying somebody to do something you can legally do yourself. Part 3. If you have 0 credit. Now let's say you have absolutely nothing. No credit cards, no installment loans, no meaningful credit history. Your first objective isn't getting a $20,000 limit. Your first objective is getting an account that reports positive payment history. One of the easiest entry points can be a secured credit card. You put down a refundable deposit. That deposit typically establishes your starting credit line. For example, $300 deposit, $300 limit. Use the card, let it report, pay it on time, repeat. Eventually, depending on the issuer, you may be able to graduate to an unsecured card and get your deposit back. The important part isn't the $300. The important part is creating a track record. You're essentially telling the financial system, I can handle revolving credit without becoming a problem. Part 4, the first big secret: don't confuse using credit with carrying debt. This is where beginners get confused. You don't need to carry a balance and pay interest to build credit. That's one of the biggest myths in the credit game. You can use a credit card and pay it off. The bank doesn't need you to pay interest every month for your account to establish payment history. In fact, paying unnecessary interest just to build credit is a terrible strategy. Use credit as a tool. Don't become the product. Part 5, utilization. Now we get into one of the biggest pieces people talk about: credit utilization. Imagine you have a $1,000 credit limit. You have a $100 statement balance. That's 10% utilization. If you have a $500 statement balance, that's 50%. If you have $900, 90%. The amount reported relative to your limits can affect your score. FICO considers how much of your available revolving credit you're using as part of the amounts owed category. My FICO. Here's the practical move. Don't wait until the due date to think about utilization. Understand your statement closing date and your payment due date. The statement balance can be what gets reported to the bureaus, depending on the issuer's reporting practices. Experian explains that utilization is generally calculated using the balance appearing on the credit report, often tied to the statement balance. Experian. So if you want a low balance reported, you can pay the card down before the statement closes. Then pay whatever remains by the due date. That's different from simply paying your bill on time. Payment timing and reporting timing are 2 different concepts. That's a detail a lot of beginners miss. Part 6. Don't obsess over 0%. Here's another thing people get wrong. You don't necessarily need every card reporting $0. The goal isn't to manipulate your credit report every single month like you're trying to make the balance disappear. The goal is to demonstrate responsible use while keeping reported revolving balances reasonable. And remember, utilization has no memory in most commonly used FICO scoring models. If your utilization temporarily spikes and then you pay the balance down, your score can recover as lower balances are reported. But don't use that as an excuse to run your cards up. The best strategy is simply, don't borrow money you can't comfortably repay. Part 7, your first 12 months. Now let's build the profile. Month 1, open your first appropriate account. Set autopay for at least the minimum payment. Keep enough money in your bank account to cover the bill. Use the card for normal purchases. Don't manufacture spending. Month 2, keep paying on time. Watch your statement. Monitor your credit reports. Month 3, still boring? That's the point. Month 4, still boring? Month 5, still boring? Month 6, now you're starting to have something you didn't have before. History. The system has actual evidence of how you behave. This is where people screw up. They get their first card. Their score increases. They get excited. Then they apply for 6 more cards. Now they have multiple hard inquiries, multiple new accounts, and a younger average age. FICO considers new credit and the number of recently opened accounts, and opening several accounts quickly can be riskier for someone with a short history. My FICO. Don't confuse momentum with permission to go crazy. Part 8. When to add your second card. Once you've established some history, you can consider another card, but don't randomly apply everywhere. Research first. Look at minimum credit requirements, income requirements, existing relationship requirements, annual fees, rewards, issuer rules, recent account restrictions, and whether the card actually makes sense for you. Here's an important distinction. Approval odds aren't the same thing as credit score optimization. A card can technically increase your available credit while still being a terrible financial decision because of the annual fee, interest rate, or spending requirements. You're building a financial profile, not collecting plastic. Part 9, the bank relationship hack. Here's something people overlook. The bank you're applying to already knows you can matter. If you have a checking account with a financial institution, maintain healthy deposits, avoid overdrafts, and demonstrate responsible behavior, that relationship may be useful when you eventually apply for that institution's credit products. It doesn't guarantee approval. Nothing does. But you're no longer completely anonymous. You have an existing relationship. That's why I like the concept of build the relationship before you need the money. Don't wait until you desperately need a $20,000 loan to open a bank account with the institution. Establish yourself beforehand. Part 10. Income matters. Here's where the 800 score obsession falls apart. Imagine 2 people. Person A, 800 credit score, $25,000 income, high existing debt, thin credit profile. Person B, 740 credit score, $90,000 income, low debt, longer history, strong payment history, stable financial profile. Depending on the product, person B could absolutely be the more attractive borrower because lenders don't make decisions using your credit score alone. The score is one piece of the underwriting picture. Credit score gets you into the conversation. Your overall financial profile can determine the answer. Part 11, the credit limit game. Now let's talk about limits. A $10,000 credit limit isn't $10,000 of wealth. It's $10,000 of potential borrowing capacity. That's a huge difference. If you have $50,000 in credit limits, but $45,000 in debt, you don't have $50,000 of financial power. You have a problem. The strongest credit profile isn't necessarily the person with the biggest limits. It's the person who can access substantial credit without depending on it to survive. That's the profile lenders want to see. Part 12, how to get higher limits. If you want larger limits, focus on the factors lenders actually care about. Maintain strong payment history, keep revolving balances manageable, increase your income legitimately, keep your existing accounts healthy, build history, avoid unnecessary applications. Then, when appropriate, request credit line increases. Some issuers allow you to request an increase without a hard inquiry, while others may use a hard inquiry. Always check before submitting the request. And here's the hack. Don't just randomly ask for an increase because you want more money. If the issuer asks why you want an increase, be truthful. If your income has increased, update your income information where appropriate. If your expenses have changed, understand that too. Your goal is to make your actual financial profile stronger, not to create a fictional one. Part 13, the authorized user strategy. Now let's talk about authorized users. An authorized user can sometimes benefit from another person's account history if the issuer reports that account to the authorized user's credit files. But here's the part TikTok doesn't always tell you. Not every authorized user account is equally useful. You want the account itself to be healthy. Ideally, long history, clean payment history, low utilization, no recent problems, and the issuer needs to report the authorized user relationship to the relevant bureaus for it to have an effect there. Never pay someone for some magical 800 score trade line expecting guaranteed results. There are no guaranteed scores. And lenders can have their own underwriting rules. The better strategy is building your own credit history. An authorized user relationship can be supplemental, not your entire foundation. Part 14, the credit mix myth. You may hear, you need a car loan, you need a mortgage, you need an installment loan. Not necessarily. FICO considers credit mix, but it represents only one component of the score, and you don't need one of every type of account. My FICO. Don't borrow money you don't need just to manufacture credit mix. Taking a $10,000 loan and paying thousands of dollars in interest just because you want a better credit profile makes no sense. Never pay $1 to create $1 of unnecessary debt. Build credit with credit you're actually prepared to manage. Part 15, the perfect score. Now let's talk about 850. Yes, 850 exists. But here's the uncomfortable truth. You don't need 850. Once your credit profile is excellent, moving from 780 to 800 to 820 can matter much less than people think. Lenders don't all use the same score. They don't all use the same scoring model, and they don't all have the same approval requirements. So stop treating 850 like the finish line. Think in tiers: poor, fair, good, very good, exceptional. The objective is to move into the strongest range while simultaneously building a profile lenders actually like. Part 16, the 800 plus formula. If you're chasing an excellent FICO profile, here's what you want over time. 1. Zero missed payments. Payment history is the largest FICO category at 35%, my FICO. 2. Low revolving utilization. Don't consistently max out your cards. 3. Long history. Don't constantly close your oldest accounts without understanding the consequences. 4. Controlled applications. Don't shotgun applications everywhere. 5. A healthy mix when it naturally develops. Don't take unnecessary loans just for a scoring formula. 6. Clean reports. Review your reports and correct legitimate errors. 7. Stable finances. Your score isn't the whole story. Part 17, the biggest secret in credit. Here's the biggest secret: time. Everybody wants a hack that turns a 550 into an 800 next month. Sometimes legitimate errors can be corrected quickly. Sometimes paying down revolving debt can create a relatively fast score improvement. But you cannot manufacture years of credit history overnight. Length of credit history is part of FICO's model, including the age of your oldest account and the average age of your accounts, my FICO. That's why the smartest thing a young person can do is start responsibly before they desperately need credit. Your 20-year-old self can do something your 25-year-old self can't. Give your credit profile 5 years of clean history. Part 19, the application strategy. When you're preparing for a major application, don't randomly apply for cards right beforehand. Think about the sequence. If you're planning to apply for a mortgage, auto loan, major personal loan, business financing, or another significant credit product, be careful about opening several new accounts immediately beforehand. New applications can create hard inquiries, and new accounts can reduce average account age. My FICO. Instead, plan the credit moves before the major financing event. You don't want to spend months building a profile and then destroy the presentation of that profile 2 weeks before applying for the loan you actually wanted. Part 20. Stop chasing approvals. Here's another major mistake: applying for a card simply because you think, I might get approved. That's backwards. Before applying, ask, what am I trying to accomplish? Do I need rewards? A higher limit? Percent introductory APR? A balance transfer? Business spending? Travel benefits? Building credit? Then find products that fit that objective. You're not trying to collect approvals. You're trying to build a useful credit infrastructure. Part 21, what to do if you have bad credit. If you're already damaged, don't panic. Start by figuring out exactly what's causing the damage. Late payments, collections, high utilization, charge-offs, errors, too many recent accounts, thin file. Different problems require different solutions. If you're carrying high revolving balances, paying them down may help the utilization portion. If you have inaccurate reporting, dispute the actual inaccuracies. If you're missing payments, stop the bleeding first. Set up autopay. Contact creditors when appropriate. Build a system that prevents another late payment. The goal isn't to look perfect for 1 month. It's to stop creating new damage. Part 22, what not to do. Don't lie about your income. Don't manufacture documents. Don't use fake identities. Don't buy fake trade lines. Don't dispute accurate information just because you don't like it. Don't intentionally max cards out. Don't take unnecessary loans. Don't open 10 accounts because somebody on social media said it's credit stacking season. Don't pay interest just to build credit. And don't believe anyone promising you a guaranteed 800 or 850. Those aren't hacks. They're ways to create bigger problems. Part 23, the real credit stack. If you want to eventually build serious borrowing capacity, think about the progression. Stage 1, establishment. Get your first account. Create positive payment history. Learn your statement and due dates. Monitor your reports. Stage 2, stabilization. Keep utilization controlled. Build several months of clean history. Avoid unnecessary applications. Stage 3, expansion. Add appropriate accounts strategically. Request increases when it makes sense. Build relationships with financial institutions. Increase income. Keep debt manageable. Stage 4, optimization. Now you're looking at better rewards. Higher limits, lower rates, better financing, business credit, travel cards, cash flow tools, and other financial products that actually fit your situation. Stage 5, leverage. This is where credit becomes a tool instead of a liability. You can use strong credit to potentially access better financing terms, but remember, borrowing capacity isn't wealth. Cash flow pays the debt. Part 24, your 850 checklist. If your goal is to eventually build an elite credit profile, here's your checklist. Payment history. Never miss payments. Utilization. Keep revolving balances manageable. Age. Let good accounts mature. Applications. Apply intentionally. Mix. Let different account types develop naturally. Reports. Check all 3 bureaus. Errors. Dispute legitimate inaccuracies. Income. Increase your actual income. Debt. Keep debt manageable relative to your cash flow. Relationships. Build relationships with financial institutions before you need major financing. Consistency. Stay boring because boring credit wins. Final. Stop chasing 800. Here's what I want you to understand. Credit isn't a video game where the objective is simply to reach 800. The objective is to become someone lenders consider a reliable borrower. An 800 score with terrible cash flow isn't financial freedom. A massive credit limit with massive debt isn't wealth, and a perfect score doesn't guarantee every approval. The real goal is clean history, low risk, controlled debt, strong income, long-term relationships, responsible borrowing, and enough financial discipline that when a bank says, here's $10,000, you don't hear free money, you hear potential liability, use it strategically. That's the difference between someone who simply has credit and someone who actually understands credit. So stop obsessing over the number, stop chasing 800 just so you can screenshot it. Build the profile, build the history, build the income, build the relationships, build the financial discipline, and let the score follow.